How to determine the break-even price when placing a short vertical option spread. When placing a short vertical option spread, the break-even price is the price at which you will neither make a profit nor a loss on the trade. To calculate the break-even price for a short vertical option spread, you need to know the strike price of the option you sold, the option you are short, and the option you bought, the option you are long, as well as the net premium you received or paid when you placed the trade. The formula to calculate the break-even price is break-even price equals strike price of short option, net premium received/paid. For example, let's say you sold a put option with a strike price of $50 for $3, and bought a put option with a strike price of $45 for $1. The net premium received in this trade is $2, i.e., $3, $1, so the break-even price would be break-even price equals $50, $2 equals $48. This means that in order for you to not lose any money in this trade, the price of the underlying asset needs to be above $48. Another way to think about is to consider the sold option as a liability and purchased option as an asset. So to break even, your asset's strike price need to be higher than your liability's strike price. Keep in mind that this is a simplified example, and in real-world trades, there may be other factors such as commissions and fees that can affect your break-even price. There are a few more things to keep in mind when calculating the break-even price for a short vertical option spread. The net premium received or paid is the difference between the premium received for selling the short option and the premium paid for buying the long option. If you received more for the short option than you paid for the long option, your net premium will be positive and you will have a lower break-even price. If you paid more for the long option than you received for the short option, your net premium will be negative and your break-even price will be higher. It's important to note that the break-even price only applies to the trade at expiration, meaning that if the price of the underlying asset moves to the break-even point before expiration, your option position is at the money, ATM, but you're not breaking even. Since options have time value, your net premium will lose value as the option nears expiration if it's still ATM. The break-even price doesn't factor in any potential losses from other variables like change in volatility, dividends, etc. That could affect the option's value. And also keep in mind that for short vertical spreads, the risk/reward profile is not symmetric, in the sense that your maximum profit is limited to the net premium received, while the loss potential is much greater and determined by the difference between the strike prices. Knowing how to calculate the break-even price is important as it helps you determine the minimum price at which the underlying asset needs to be in order for you to avoid making a loss on the trade. But also, it's very important to also know your maximum potential loss and also have a plan in place for managing risk in case the price of the underlying asset moves against you.